If you're thinking about coming to the summit, it's a really great opportunity. I can't emphasize how valuable it is just to hear about all the new innovations, but also the networking opportunities.
It's a great place to network, and they've done a fabulous job with bringing in certain speakers from around the mortgage industry to kind of provide their insight.
If anyone is on the fence of whether they should attend this event next year, there's just jump over the fence. There's so much content that you are going to get out of this.
I definitely highly recommend coming. You get a lot of just engagement with the OB team themselves, but also get the additional knowledge and information about what they're working on.
If you're setting your schedule for next year, for deciding which conferences you're going to be sending people to, you're going to be attending yourself. I mean, this is one that you have to show up to.
So our innovation is going to focus on the most important aspects of your job.
There's something so magical about being able to share our profitability expertise that only Optimal Blue can provide.
We're not just delivering software, we're delivering solutions that empower you to make smarter decisions, operate with more efficiency, and stay ahead of the curve.
Welcome to Optimal Insights, your weekly source for real-time rate data and expert capital markets commentary, brought to you by Optimal Blue. Let's dive in and help you maximize your profitability this week.
Welcome to Optimal Insights. I'm your host, Jeff McCarty, Vice President of Hedging and Trading Product at Optimal Blue. In today's episode, I'll sit down with Justin Monahan, Agency MBS Product Manager at Tradeweb, where we'll discuss how Tradeweb provides liquidity and transparency in the mortgage-backed security markets. And as always, we'll check in with James Cahill and Kevin Foley for a look at what's happening in the markets today. Our clients and industry partners have long relied on Optimal Blue for trusted insights and commentary, and these podcasts are an evolution of our commitment to keeping the industry informed. So we have a great episode today. As mentioned, we're going to be speaking from Justin at Tradeweb, really about what makes the MBS market tick, and how Tradeweb provides transparency and other tools, the ability to execute trades, pricing insights, a lot of great tools in this incredibly liquid market that we have for mortgage-backed securities. And then we'll get into some of the implications of the government shutdown. But first, just a quick look at the data. So we have the OBMI sitting at 6.244 as of the end of the week last week, the 10-year at 4.15. So really for the past 2 weeks, since the Fed announcement a couple weeks ago, we've really been pretty flat. You know, we had a little bit of a bump up in rates, but then we've been pretty flat since then, not leaning one way or the other. We'll talk a little bit closer about which way we think rates may be headed later, but looking forward to those discussions. Let's jump in. All right. Welcome, Kevin and James.
Good to be here.
Thank you.
So let's jump right into kind of the major news of the week, which is obviously the government shutdown. James, you want to kind of talk us through what implications we're seeing because of the shutdown right now?
Yeah, so a few days into it, it doesn't look like this is going to be resolving anytime immediately. So what we're kind of facing is that on Friday, the jobs report should have come out, a number that everyone is really scrutinizing these days, was really kind of looking forward to seeing. We didn't get it. The upside on that is the BLS has already said, hey, once the government opens back up, we're going to get that number to everyone pronto. Like it's going to be one of the first things that they get back out. So, you know, we'll have it once the government's open, but when that happens is the question. There is, you know, the good news is there's a couple other ways that we can kind of get to these numbers. The Dow publishes their own version of the numbers. They saw non-farm payroll at 51,000 and unemployment steady at 4.3%. So kind of in line expectation, no major movements or changes. So pretty good there. With that, there's, you know, definitely a question around, hey, what do we do if the government doesn't open for a while? Where can we look to get this data? There have been some alternate views showing up. There's some talk about looking at Indeed and job postings. I think Kevin had some kind of interesting from the Fed.
Funny enough, there is this new kind of real-time unemployment report that the Chicago Fed just released at the end of September. I don't think that this had anything to do with the government shutdown, but you know, the timing was great in that, you know, this is this new way to get sort of real-time information. So not waiting for the monthly, you know, BLS reports to have a better understanding of the unemployment rate and, demand and supply for labor. So this is by the Chicago Fed. It's something that they're calling churn, which is the Chicago Fed unemployment rate nowcast, I think. I was reading a little bit on the methodology because, there's been a lot of conversation, right, about, the BLS reports and, all the revisions that are happening, and a lot of that survey based. And there's been questions of, do we need a new, methodology? And this actually answers, I think, to some of those concerns that, folks have had out there. And what they do is they model out, what are called, vectors or flow rates of folks separating from their jobs, and then also for companies adding new employees. And it's a bit of sort of an advanced analysis. They use a lot of the publicly available data, the private sector data, as part of that. But they're also looking at things like Google search analytics. They're looking at Indeed and other websites, job postings. They're looking at organic postings of people who are, going into like self-employment from, having more full-time or regular time job. That came out right before the government shutdown. They actually have an updated report as of October 2nd. And the latest release of the final report for the end of September, which sort of would be when we would expect the September jobs number, they had the unemployment rate at 4.34% was their estimate. So it's sort of, another data point that's out there, fairly consistent with what we were seeing last couple months. So not a lot of dramatic movement, maybe from what we would expect, but I would encourage folks to go out there and check it out. It's a pretty cool, interesting, new way to stay on top of what the unemployment rate is.
One of the things these types of tools highlight for me that we've talked about as we were talking about, the firing of the BLS chief and the strength of those numbers is that there are a lot of other data points you can look at. This is the largest, most transparent market in the entire world. People are going to get their data and indications on how the economy is faring. They're not just relying on one number. And, the other thing kind of highlights for me is that, the Fed is not just one person. This is not just Powell. Every Fed region, has their own very strong head of the Fed, as well as, hundreds of employees and economists that are working through numbers and digging through numbers. They're not just waiting for that one BLS number to come out. They have all of their own models that they're looking at. So anyways, taking a step back, there's a lot of smart, hardworking people looking at a lot of data, trying to figure out what's going on with the economy. So there's my rah-rah speech about the transparency of the U.S. economy overall. I guess getting back into the government shutdown, let's talk about some few specific things we should be maybe watching for or concerned about how the shutdown itself is affecting the economy.
Yeah, there's just a couple of items with it. So first of all, last week, there's about 100,000 federal employees who had taken the buyout earlier this year, and all of them have been being paid by the government, and that ends as of last week. So that is a number that's going to impact unemployment coming into the future. With the closure of the government, FHFA has been saying that they're going to be slower to processing Ginnie pools. So that's more of a direct impact into our industry. But generally speaking, the government shutdown does not stop what we're doing. The market's still moving, mortgages still being originated, and we're all still chugging along.
Yeah, there's always, with the government shutdown, there's always a discussion about who's an essential worker versus a non-essential worker, and then who's going to get furloughed versus who's going to have to keep working but not get paid and then get paid later on. It's a little bit of a mess when you go through this, right?
Yeah, it's like you can only plan so much for the government shutting down, and then the impact is going to end up being messy at some level.
Yeah. Yep. All right, so back to the overall health of the economy, Kevin. You touched on the fact that the employment numbers that we do have are, they're okay-ish, right? There's no smoking gun that employment is falling off a cliff. Inflation continues to remain elevated but steady. Anything else to comment on there?
The only other thing that I'd say is with this churn report that the Chicago Fed is doing, that they're actually publishing unemployment rate probabilities. So 4.3% was our most recent reading, and that's the highest percentage probability that they have published out there at 28%, although next in line is ticking up 0.1% to 4.4. the probability of that was 26%. So probably, continue to expect some deterioration in the labor market, over the next month, next couple months. I think that's sort of what's priced in at this point. But overall, the 10-year has been fairly consistent. It dipped down close to 4% right around the timing of the Fed cuts, and then it's sort of back up in the 4.1 to 4.2% where it's been pretty consistently. So we're not seeing as big of a bounce back up after the Fed cut like we did last year. That was a very steep increase after the Fed initiated cuts in September 2024, but overall, relatively good place considering the rest of where we've been in 2025.
And looking at the CME, there is a projected we're getting a rate cut in about 25 days now. So we are almost certainly getting that second one, even without data coming out this week, next week. It seems the Fed has mostly made up their mind, is mostly signaling, yes, we're going for at least one more.
And what's the likelihood of that extra one then in December as well?
The December one, it looks like it's 83%. So, we're definitely getting one coming next month, and looks like we're going to get one in December as well so far.
Yeah, and I think core PCE is coming out like the day or two after the October Fed meeting. So we have already had our last core PCE, inflation reading leading up to the meeting. So that's nothing really on the inflation side too much that's going to really change the trajectory and the data that's coming later this month.
One speech that I thought was interesting that we might highlight was from Michelle Bowman, Vice Chair of the Board of Governors of the Fed. Interesting conversation around where she thinks the Fed is right now and just the Fed's role in supporting the economy, particularly around quantitative easing. Her views around the overall health of the economy are probably kind of right in line with kind of consensus right now, right? Which is that employment is starting to deteriorate. We should probably start moving faster on cutting rates to address the employment situation. And that inflation, while stubbornly high, is not necessarily at a risk to increase further. So, comfortable with inflation being a little bit higher than the target, knowing a lot of the issues right now are transitory around tariffs potentially, and that, the employment situation is deteriorating. But she did have some interesting topics around, again, quantitative easing and just the runoff of securities on the Fed's portfolio, particularly around mortgage-backed securities. And she actually argues that rather than allowing mortgage-backed securities to run off naturally, the Fed should proactively look to sell some of the mortgage-backed securities in the Fed's portfolio. We have not heard much of that. There's not much talk about that through the broader Fed, but it is worth keeping an eye on.
Yeah, and obviously to tie that into the effect that would have on mortgage rates. So if the Fed were to accelerate selling mortgage-backed securities, that would widen the spread between Treasury and MBS and ultimately lead to, net, it would lead to higher interest rates. But I think the thinking behind the statement, which I thought was really interesting, Jeff, is the Fed kind of picking favorites, picking winners and losers too much by expanding their holdings to really anything beyond just treasuries. Another component of that statement was focusing more on a treasury-only balance sheet on the Fed. Another component of that was also not playing favorites amongst the term structure within the yield curve. So not trying to push the 10-year down, let's say, more than it should go down in order to help, or offset mortgage rates. The whole idea was you want to have a neutral effect on the overall demand for the yield curve. So, that means for shorter term securities, you want to buy a similar amount of shorter term securities as you would longer term securities, so that you're not like playing favorites too much with the yield curve. So yeah, it was a very interesting statement. I always appreciate when, folks in the Fed issue statements like that publicly so we can get a better understanding of what their thinking is.
Yeah, you can't imagine that type of talk will be popular with the current administration. I can't see this type of thinking gaining more traction as this administration, adds more of, quote, their people to the Fed Board of Governors, but certainly worth keeping an eye on to see if that gains traction. Again, by dumping supply of mortgage-backed securities in the market, you're going to drive down prices and drive up rates, relatively speaking. So, as kind of overall rates in the broader economy go down, you're going to see mortgage spreads potentially widen if they were to actually implement this type of policy, which, I think is unlikely, but it's still interesting to hear that talk out there.
I agree with what you're saying there, Jeff. It seems that would be kind of antithetical to what the administration wants, although it would address some of the mission creep that the Fed has been kind of accused of the past couple of years. Like, hey, have we been picking favorites? Have we been stepping where we shouldn't? Should we step back and get out of this? Ironically, it would address the mission creep, but it would push mortgage rates up, which is just not what the administration wants at all. So.
Yep. Yeah, for sure. And I think to your point, James, Besant had that article in the Wall Street Journal a few weeks back that was the gain of function policy from the Fed. And this yeah, to your point, this is exactly, I think, what he's talking about there. But ironically or not, it's not in line with some of the other objectives of the administration in terms of their Fed and interest rate policy.
It's a classic econ. You're trying to move the direction one way and you've got three other things pushing back against you.
Yep.
All right, good. Anything else?
That's a good recap.
Yeah.
Just a lot of Fed speak coming this week. Otherwise, not too much data. Hopefully when the government opens, we'll see quite a bit of it all at once.
We will be ready for it and ready to talk about it. Thanks, Kevin. Thanks, James.
Thank you.
Thanks, guys.
All right. So as promised, welcome in Justin Monahan. Justin is Agency MBS product manager at Tradeweb on the institutional side of the business. So yeah, Justin, thanks for joining us today.
Appreciate you guys having me on here.
So I've worked with Justin for a number of years now, so excited to get his expertise on something we talk a decent amount about on this podcast, but excited to get a little bit more details, really kind of, how the sausage is made. How do MBS prices actually show up on a screen? How does that, one of the main drivers of how loan pricing changes on a day-to-day, hour-to-hour, minute-to-minute business, getting a little bit of weeds there. A little bit more about Tradeweb. Tradeweb is a, financial technology company, a global leader in fixed income, and really from our perspective, kind of the de facto leader in the industry in terms of MBS price discovery, TBA trading, specified pool trading. So maybe we just start there, Justin. What does Tradeweb do in this industry and kind of more broadly?
So, we, as Jeff said, right, we're a fixed income technology company. We've been around for over 25 years. The agency mortgage product was actually one of the anchor products that were founded when the company was founded and outside of U.S. Treasuries. So extensive tenure in this market. And very much a lion's share of the electronically traded portion of this market, particularly in TBAs and an ever-growing presence in this agency-specified pool market as well. So we measure ourselves against Trace ever since Trace volumes became public. And Trace breaks down average daily volumes by dealer to dealer, dealer to customer, and then also on an ATS trading platform. Tradeweb on the institutional side is not categorized as an ATS. But of the dealer to customer market, which is where my platform or our platform sits, we represent about 90% of that average daily volume in the TBA market.
Yeah, when you say dealer to customer market, that's probably where the majority of our listeners would be familiar with it, right? So when we say, we're trading 2 million UMBS, 30 years, 6% coupons in November with a broker dealer, we're often going to Tradeweb to do that and execute that trade.
That's right. Yeah, so we have the TBA platform is what's called an RFQ platform, or request for quote. So all of our clients interact with, the bulge bracket dealers. We have 17 liquidity providers in the TBA market and a total of 31 in the specified pool market, which that number has been growing since 2020, since we launched the trading platform. But request for quote, you can go up to 4 dealers at a time for immediate price transparency and execution. And then really our bread and butter, right, is the integration capabilities that we have from an audit trail perspective, best execution, and then straight through processing. So there's really very low touch for most of our account base in terms of manual trade entry.
Yeah, we see that obviously a lot in our products, specifically in how we integrate with you and interact with you, whether it's our traders or our technology. Again, a super important part of the process, because that's ultimately the main driver of that loan price. So when we talk about how Treasury prices move and how MBS prices move and how, that affects the rates that we're offering to borrowers, we're getting those prices and executing those trades directly from you. So let's get into the weeds a little bit there and just kind of, start with an example, right? So if we're talking about a 6.25 note rate, that note rate is probably going into like a 5.5 coupon. We go into Tradeweb and we say, all right, right now, UMBS 5.5 coupon is trading at par and 20 ticks, a tick being the 32nd of a point. So, par 0.625 in terms of prices. Where does that price come from?
Yeah, so our composite is widely trusted as sort of the market standard for price transparency for TBAs. It is a dealer sourced composite, so any and all of those 17 liquidity providers can contribute markets to us. We have an algorithm that essentially analyzes in real time those market updates on the bid and offer side of the market. And what we essentially publish is the best bid and best offer within a standard deviation of what we're getting. So it is an indicative market. So it's not necessarily firm levels, as you probably have heard in like other markets like US Treasuries and interest rate swaps, which are more of a streaming protocol where it's a dealer direct stream to clients and clients can execute or aggress on those levels. TBA market is still truly indicative, but part of I would say the function behind the scenes of what goes into those contributions is a reflection of what's happening in the wholesale market or the dealer to dealer market, which is more of a central limit order book model, where those are live executable levels. So if there's a cash market pictured in, let's just say, UMBS 36%, there's also usually coupon swap markets, right? So 50 basis point coupon swaps that you could ladder down and then come up with a theoretical mid price and then a bid and ask price off of those individual legs. So there's definitely each dealer probably has their own methodology of how they're doing this to arrive sort of at a generally the same level as the rest of the market or the consensus, but that's sort of the things that are happening behind the scenes. There's also a combination of hedge ratios that are tracking Treasury movements as well, right? And how you should materially up or down tick those TBA prices as well.
There's a lot going on there. I guess to simplify that even a little bit more, as you said, you've got an algorithm. It's looking at actual inputs, different sides of the market to come up with this indicative price. Again, indicative being important because when we go and actually trade these, that might not be the price we get from a broker dealer. Reiterating that point. For the most liquid coupons, obviously you're going to be pretty close, if not exactly on top of that, right? Most dealers, use that to determine then how they price. Obviously, sometimes on those, more illiquid coupons, it might be, not quite what you get when you call a broker dealer when you go to trade them on Tradeweb.
If we isolate, so we run analysis on how accurate our composite actually is. We've actually in the past 2 years or so have had a really renewed focus on like the data that's available to us, whether it is the composite data, trade data. And if we just isolate to current coupon mortgages that are traded outright. So as the example before, you're going to sell 2 million UM36s in November and you go to 4 dealers at a time on the RFQ ticket, 95% of that volume that transacts on our system is done within 1/32 of our mid price. So it is extremely accurate, and that's why it's really widely accepted as kind of as the standard for the market.
Yeah, which is it's accurate, it's trusted, which is good because we use that. The industry uses that price from you, right? Not just to execute trades. They're using it to hedge their pipelines. They're using it to price their pipelines, price loans to the market to say, hey, borrower, if you want, a 6% note rate, this is the price you're getting at this moment in time. If you want a 7.5% note rate, this is the price you get. And all those dynamics that you're describing feed directly to what the entire industry is quoting to the borrower. So it's important that we have this trusted source of pricing that you provide.
For sure.
All right. So, the pretty good breakdown of kind of where prices come from, how that shows up on the screen, and then ultimately, again, flows through to, say, borrower pricing. What happens from there? What happens what are kind of the mechanics of when a trade actually occurs?
Sure. So we're at the front end of the trade life cycle, right? So we have a lot of pre-trade tools that exist on the system, things like smart dealer groups, which will help you with selecting, which dealers have a very high hit rate or which perform better for a specific type of client. But at time of execution, for both the liquidity provider and for the customer, we kick off our post-trade process. This is really critical for the dealers because they have an obligation to report these trades to Trace. The guideline is as fast as possible, but within 15 minutes. So with like the velocity and the amount of trades that, let's just say like the top 5 or 6 dealers are seeing on a daily basis, it's really critical for this connection to work seamlessly. And then the client side too, right, is you want your risk in line as fast as practically possible. So we send those execution messages typically down a fix channel to wherever you're going to be holding those trade details. Most of the life cycle after that is handled away from us. But that first piece is really important, the timeliness and the accuracy to get all those details in and correct.
Yeah, and one thing, we touched on how much of the market you see and control, but we should reiterate just how big this market is in general. We've talked about this a lot in the podcast, but this is a huge market beyond treasuries. It's the biggest fixed income portion of the market in the world, right?
Yeah. So for context, our year-to-date average daily volumes on the system in TBA are 190 billion. I think the total market, right, if we're looking at full on, I think it's in the realm of like 230 to 240 billion. Actually, it might be closer to 250 billion the last time I checked. So pretty substantial.
So, just a ton of volume. So having those processes that you described in place, all those back-end processes that happen after you say, hit that $2 million trade, making sure that is tracked all the way through is of vital importance. So those kind of non-sexy things that you do on the back end, make the market work, make the mortgage industry liquid, dynamic, which becomes important all the way through to the borrower, ultimately.
For sure.
All right. So that's a good lead in to maybe a few other things we wanted to touch on, right? It's not just that you're providing pricing, you're providing, the ability to execute some of these kind of standard trades. There's other functions that Tradeweb provides. Maybe you can touch on a few of those.
Yeah. So if we talked about that, let's just call it a hedge in sixes that you've traded a few months forward, right? Well, what are your options with that trade, right? You could deliver collateral into that. If you securitize enough into that coupon, you could roll that position. So just doing a traditional dollar roll to move that forward. You could do a coupon swap if production is shifted up or down. But as you go through, one of the nice things that we've done that's been a trade protocol we've had around for a long time is our round robin, which is essentially an electronic version of an assignment of trade. And what's nice about that is it takes the operational bandwidth of like having to make or take delivery of bonds away, because you can just collapse open positions that you have, like open longs and shorts that you may have on between different liquidity providers. So in the case where you sold, again, sixes forward in November, let's just say come settlement time, you're going to actually swap those into 5.5s because that's where production has really lined up. So you traded that initial trade forward with a particular dealer. Now you end up doing a 50 basis point coupon swap and you shift your hedge lower into 5.5s. Well, that buyback of that hedge may be on with a different dealer. So before round robin or an assignment of trade, you'd have to take in bonds and deliver bonds out. What round robin does, it allows you to step out of that trade and compress those, and you ultimately end up with a TBA pair off between dealers. But it's a riskless trade that is really, really efficient. We see about 50 billion in volume for this trade type on our system on a very regular basis. But the beauty of it is it allows the customer to go out and get the best level in the market to close those open positions out. So it's a very useful and widely utilized tool.
Yeah, it's a great tool. It again, very simply, just another way of providing liquidity in the market to originators so that they can, as you said, get the best price possible as you're getting out of the trade to be able to then handle that kind of the dynamics of who you actually executed the trade with originally. So, a super liquid market already, these types of tools provide more liquidity, more efficiency in trading, and ultimately better performance for the mortgage company, better prices to the borrower. So yeah, that's a great example. And again, just great tools and how much goes into this market that a lot of folks don't see. All right, well, maybe we end on, kind of what you see going on in the market. What are some of the main drivers of mortgage-backed security pricing on a daily, minute-to-minute basis?
Yeah, there's a lot of, obviously mortgages it's a macro rate product, right? It's a spread product, but off of macro rates. So generally speaking, like any action in, U.S. Treasuries, particularly between like the 5-year and 10-year points on the curve, are going to drive price action. Now, the spread to those points on the curve are really driven by supply demand technicals. So if you've got different things, you're talking like Fed cutting rates on the short end, you've got the growing presence of mortgage related ETF inflows, so you could have really high demand over a certain timeline. So there's a lot of different levers which are going to drive the upward or downward momentum of the TBA market. Specs are a whole different animal, but we'll keep it focused on the TBA world first.
Yeah, no, we've done. We'll bring you back sometime to get into specs in more detail. We have done a little bit of a breakdown of specified pools and why those are important. Yeah, so those are things we've hit on as well. Looking at, we obviously watch the 10-year closely, our market, but there is a dynamic between the 10-year and mortgage rates as well. How that changes over time or even on a minute-to-minute basis is certainly interesting to watch.
Yeah. One of the other themes too, right, is it's the theme of supply and demand, but it's like how active are the bank buyers in this product, right? And that can really drive basis tightening or widening depending on how active they are and what products they're adding or shedding at a particular time series.
Yeah, I think we actually talked about that a couple of podcasts ago. Jim mentioned, I think it's, we talk a lot about dynamics. This is a global market, right? But still, I think it's 70 to 80% of MBS holdings are still within the U.S., even though, it is traded internationally. I think that, but mostly by, those parties that you just mentioned. All right, that was great, Justin. Thank you so much. A really good overview of kind of, again, as I said earlier, how the sausage is made. How does that price show up? All the other dynamics that go into trading mortgage-backed securities that we talk about so much, but is very nuanced, very complicated, and we need, obviously someone like Tradeweb there to provide that liquidity in the processes for us.
Yeah, it's a big responsibility for us, but we enjoy it. And we're grateful for the opportunity to where we sit in the market.
Great. So if anybody wants to get in touch with Justin or Tradeweb, we'll make sure we post something in the comments on LinkedIn, or certainly please feel free to reach out to us. So Justin, thanks again. Great conversation.
Appreciate it. Thanks, Jeff.
Thanks. That's it for today. Thanks again to Justin Monahan from Tradeweb for joining us. Thanks, Kevin and James, as always. Join us next week for another episode of Optimal Insights, where we'll continue to provide you with the latest market analyses and insights to help you stay ahead. Check out our full videos on YouTube. You can also find each episode on all major podcast platforms. Thanks for tuning in to Optimal Insights.